In a market that's supposed to move like a glacier, gold just behaved like a lightning strike. In January 2026, gold surged to roughly $5,608 an ounce, not as a slow climb over a year, not as a steady grind over a quarter. It reached that level after an already dramatic run, and then it whipped around hard enough that by February 13th, 2026, it was trading near 4,970. That's not a minor fluctuation. That's the signature of a market repricing risk suddenly, while the rest of the financial world tries to pretend everything is normal. And here's the part that should bother you. Moves like that are rarely the beginning of a story. They're usually the mid-sentence warning. When gold does this, it's often because something in the background has already changed. Something about confidence, something about collateral, something about who trusts what and for how long. Institutions don't wait for headlines. They move ahead of them. They position when the public is still debating whether anything is wrong. And if you've ever wondered how shocks seem to arrive out of nowhere, it's usually because the people closest to the plumbing saw the pressure building while everyone else was watching the paint on the walls. What I'm about to reveal changes how this move in gold looks, because the price spike is only the surface. Underneath, you can see something else entirely, a pattern, a contradiction, a dislocation that shouldn't exist in a stable system. And when that dislocation shows up at the same time, central banks are buying hundreds of tons of gold. You're not looking at a random rally. You're looking at a signal, not months from now, not weeks from now. But the data tells a different story, because the data shows that while most people are looking at the price, the real message is in the behavior, the urgency, the way gold moved as if it was front-running a shock that hasn't been formally acknowledged yet. Welcome to Macro Decode. This is the channel where we take the headlines apart, trace the flows behind them, and translate institutional moves into plain English before the crowd catches up. If you've ever felt like the real story only becomes clear after it's too late, you're in the right place. Subscribe if you want to keep hearing what the data is whispering while everyone else is distracted. And if you're watching from somewhere outside the usual financial centers, drop a comment with where you're tuning in from. The smartest macro conversations often come from the places the cameras don't point at. Now let's talk about what actually happened. In late January 2026, gold pushed to a fresh all-time high around 5,600 an ounce. In some trading windows, it printed near 5,608. When gold rallies on ordinary optimism, you see a smoother curve. You see pullbacks that look like profit-taking. You see the kind of order flow that feels like a trend. This didn't look like that. This looked like urgency colliding with thin liquidity. It looked like the kind of buying that doesn't care about a few dollars, because it's not optimizing for entry. It's optimizing for certainty. It's the difference between someone shopping and someone insuring a house while the neighbor's roof is already on fire. Then, after that peak, the behavior shifted. The market became jumpy. It didn't just cool off, it started swinging. By February 13th, 2026, gold was quoted around 4,170. In a world where gold is often described as the slowest of major assets, that kind of movement is a clue. Here's the central mystery. If the world is stable, if inflation is contained, if rates are restrictive, if growth is cooling but fine, then why would the most conservative store of value asset on the planet behave? Like a risk-on momentum trade? That's your first contradiction. Because the official story says stability, and gold is screaming something else. Now, when you see a contradiction like that, you don't start with feelings. You start with history, because gold is one of the few markets that has repeated the same message across decades. Different eras, different central banks, different political cycles, same basic pattern. Let's go back. In 2008, the global financial system cracked. When credit stopped trusting credit, the world discovered a brutal truth. When confidence breaks, you don't just lose money, you lose liquidity. You lose the ability to turn assets into cash at the moment you need cash most. Gold's behavior around that era wasn't a simple straight line. Then in 2011, you got another gold surge, not because the world suddenly loved jewelry, but because the sovereign debt question moved to the front. When the market starts doubting governments, gold doesn't need a marketing campaign. It becomes the asset people reach for when they want something outside the promise structure. Then March 2020. A lot of people remember that period as a stock crash and a stimulus response, but the most important feature was the funding stress, the scramble for dollars, the way even safe markets were seizing because the plumbing couldn't handle the speed of deleveraging. Gold sold off briefly in that chaos because everything sold off, and then it surged as the interventions arrived and confidence in paper stability had to be restored with unprecedented measures. Now look at what ties those episodes together. It's not that gold goes up when things are bad. It's that gold behaves violently when the system's confidence mechanism changes. In 2008, it was counterparty trust. In 2011, it was sovereign trust. In 2020, it was funding and collateral trust. And in 2026, the pattern looks familiar. Because while headlines debate soft landings, the deeper data shows a slow erosion in the one thing modern finance depends on: unquestioned belief that paper promises will always clear smoothly. The next layer is institutional behavior, the kind that's documented, measured, and hard to dismiss. According to the World Gold Council, central banks bought about 230 tons of gold in Q4 2025. That's not a small number. That's not a token allocation. That's hundreds of tons in a single quarter at elevated prices. And full year 2025 buying is cited around 863 tons in some widely discussed tallies, again at prices that were already historically high. Think about what that implies. Central banks are not momentum traders. They don't chase a chart because it looks strong. They buy for reserve structure, for long-term security, for settlement confidence, for the kind of asset that doesn't rely on someone else's balance sheet staying healthy. It's because they're trying to reduce dependence. Dependence on what? Dependence on the reserve system that has been dominated by U.S. treasuries and the dollar. Dependence on a single issuer's fiscal path. Dependence on the idea that if you hold someone else's debt, it will always be the most liquid, most trusted thing in the room. Now overlay another hard number, 1 trillion by 2036. That's not a political statement, that's arithmetic. And arithmetic becomes a market problem when it collides with interest rates that aren't near zero anymore. Because higher rates don't just affect mortgages, they affect the interest expense on the largest debt pile in the world. And when interest expense grows, the feedback loop tightens. More debt means more interest means more borrowing means more issuance. More issuance means more demand for buyers. That's the kind of question gold answers before bond yields do. So you have the players, central banks accumulating metal, macro funds openly discussing gold as a reserve alternative, fiscal arithmetic pushing the debt mechanics into a higher stress regime. But none of that explains why the market would feel dislocated, why you'd see signs that different parts of the gold universe are telling different stories. This is the part no one is discussing, because it requires looking at how gold actually trades. Most people see gold as one price, a number on a screen, but gold is two worlds at once. There's paper gold, and there's physical gold. Paper gold trades in futures markets. It's liquid, it's levered, and it's designed for hedging and speculation. Physical gold is the actual metal, in vaults, in bars, moved through logistics networks, delivered, stored, insured. In a calm system, paper and physical move together. Not perfectly, but closely enough that the gap is small and arbitrage keeps them aligned. In a stressed system, that alignment can wobble. And one of the clearest signs of wobble shows up in the mechanism called exchange for physical, or EFP, where traders swap futures exposure for physical-related positions. When that mechanism gets strained, spreads can widen in ways that don't make sense in normal conditions. In recent episodes, market commentary has pointed to EFP spread blowouts, described as over $60 in gold and over $1 in silver. They don't show up because someone misclicked. They show up when the cost of turning paper into physical exposure suddenly spikes. And when that happens, you're staring at a dislocation. Futures are trading. Physical pathways are strained. That gap cannot persist forever. Because if physical is truly scarce, the paper price eventually has to reconcile. And if paper is truly abundant, physical premiums eventually fade. But when the gap widens at the same time gold is making violent price moves, you have to consider that something is causing a temporary breakdown in the normal glue that holds those worlds together. Now let's anchor this with evidence, not vibes. Start with the volatility signature, roughly 5,608 at the peak in January 2026, around 4,170 by February 13th, 2026. That's a swing of about $638. In percentage terms, that's around 11 to 13%, depending on exact prints. In gold terms, that's enormous short window. Then the institutional evidence, central banks buying about 230 tons in Q4 2025, and widely cited. Full year totals around 863 tons in 2025. That's thousands of metric tons over a few years, at historically high levels compared to most modern decades. 1 trillion by 2036, in a rate regime where interest costs matter again. Now ask the simple question, if the reserve system was perfectly stable, why is the world's most conservative buyer category central banks still accumulating gold at scale? If inflation was permanently conquered, why is gold acting like it needs to front-run risk? If liquidity was abundant, why do you get episodic stress signals in the spread mechanisms that connect paper to physical? Here's where it gets interesting. These are not isolated facts. They form a chain. And the chain points toward one conclusion. The system is experiencing a confidence transition, and gold is functioning as a barometer for that transition. Because gold is the asset you don't need to trust. A treasury is a promise to pay, backed by a state's taxing power and credibility. A bank deposit is a promise, backed by a bank's balance sheet and the safety net. A money market fund is a structure, backed by collateral and rules. Gold is a bearer asset. It just is. That doesn't mean it's perfect. It doesn't mean it can't be volatile. It doesn't mean it's the answer to everything. But it does mean that in moments when trust is being recalibrated, gold becomes the simple alternative to complicated promises. Now let's talk about mechanism, because people often treat these episodes like magic. Like gold sensed something. Markets don't sense. Markets transmit. So what transmits the signal? One of the cleanest ways to understand it is through collateral. Modern finance runs on collateral the way a city runs on water pressure. If the water pressure is stable, everything works. Faucets run. Fire hydrants are ready. People don't think about it, but if the pressure drops, you don't immediately see it on every street. You see it first in the higher floors. You see it in the places most dependent on flow. Then you see it spread. Collateral works like that. When collateral is trusted and abundant, leverage is comfortable. When collateral becomes questioned, leverage becomes fragile. Gold spikes often coincide with moments when the collateral ecosystem is under stress or when the future credibility of key collateral is being questioned. How does that show up? It can show up as margin changes, where leverage becomes more expensive. It can show up as funding stress, where the cost of borrowing against assets rises. It can show up as spread blowouts, where the normal conversions between markets become pricier. It can show up as forced selling in one asset class that triggers emergency buying in another. Think of it like this. Imagine a crowded theater. Everything is fine as long as everyone believes the exits will work. People sit calmly, they chat, they don't rush. Now imagine a small puff of smoke, not a big fire, just enough that someone smells it. What happens? A few people quietly stand up and move toward the exit. They don't announce it. They don't panic, but they move. If others notice, more people move. Then suddenly the exits become the story. Not because the smoke grew, but because the belief about the exit capacity changed. Gold is like the exit in that metaphor. When institutions begin to suspect the crowd might need the exit, they move early. And you can see it in their actions. Central banks buy metal, funds build exposure, physical pathways show strain, spreads widen. Meanwhile, the public narrative often stays calm because narratives update slowly. So what does this mean going forward? Historically, when you see this combination of violent gold repricing, institutional accumulation, and structural fiscal arithmetic, you don't get one clean outcome. You get a range of scenarios, but they tend to rhyme. Scenario 1 is conservative. The system absorbs the stress through higher yields, tighter financial conditions, and periodic volatility spikes. In this scenario, gold remains supported because the market keeps pricing the long-term confidence cost of financing large deficits in a higher rate world. Scenario 2 is moderate. Stress triggers policy responses that soften the funding strain. That can mean a shift in rate expectations, a change in liquidity operations, or other mechanisms that keep the system clearing. Historically, those responses can stabilize markets in the short run while reinforcing the long-term appeal of gold as a hedge against the credibility cost of perpetual intervention. Scenario 3 is aggressive. A real shock hits the collateral chain. Something forces rapid deleveraging. Spreads blow out, liquidity thins. The system has to choose between allowing a painful reset or intervening strongly. In episodes like that, gold's behavior can become even more volatile, not because it guarantees anything, but because it becomes the focal point for trust when other assets are being repriced. Notice what's missing. There's no need to predict a single number. There's no need to pretend certainty. The correct posture is to watch the indicators. Watch whether central banks keep accumulating at scale. Watch whether paper-to-physical dislocations widen or normalize. Watch whether funding and collateral stress shows up in the quiet places first. Watch whether deficits and issuance keep accelerating while buyers demand higher compensation. Because if the current pattern continues, history suggests that markets eventually face a reckoning between paper promises and trust realities, not in a dramatic cinematic moment necessarily, but in a gradual repricing punctuated by sudden jolts. And that brings us to the divide. In every cycle, there are two groups. There are the people who watch headlines and assume the system's health based on what's being said. And there are the people who watch the plumbing and infer the system's health from what's being done. It's not about being smarter. It's about paying attention to the right layer. When the plumbing shows strain, the institutions notice first. They don't announce it. They don't debate it on social media. They reposition. Retail tends to move last because retail is trained to trust the official narrative until the moment it breaks. And by the time it breaks, the opportunity is usually gone and the risk is usually higher. That's why the information gap becomes a wealth gap. Not because anyone is evil, not because there's a secret cabal, but because proximity to data and plumbing is an advantage. And the market rewards early positioning, not late realization. So when gold signals like this, the question isn't whether gold is up or down week to week. The question is what gold is revealing about confidence, collateral, and the global reserve mindset. A surge to roughly 5,608 in January 2026, followed by violent swings into mid-February, is not just a chart. It's a message. Central banks buying about 230 tons in Q4 2025 is not a curiosity. It's a clue. Spread dislocations and physical conversion stress are not trivia. They're stress fractures in the connective tissue. And the fiscal arithmetic isn't a political debate. It's a long-term pressure system. When you put it together, you get a picture of a world where the reserve system is being quietly diversified, where trust is being recalibrated, and where gold is acting less like a sleepy commodity and more like an early warning sensor. This is macro decode, where we connect the dots before they become headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether this unfolds. The question is whether you understand the signal before the shock makes everyone else understand it for you.